It's time for Yahoo Finance's Market Minute. Stocks searching for direction as investors brace for President Trump's tariff announcement. Shares of Tesla falling after the EV maker's first quarter deliveries came in well below estimates, hit by weak demand. It marks the worst quarter for Tesla's deliveries since 2022. And Coreweave climbing in its fourth day of trading after going public on Friday. The AI cloud company serving as a test for the IPO market, marking the biggest U.S. tech IPO since 2021. President Trump's social media company Truth Social filing papers with the SEC that would allow Trump's trust to sell almost 115 million shares of stock. That's the entirety of the trust holdings. As of Tuesday's close, Trump shares would be worth $2.3 billion. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth. I'm Julie Hyman in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, it is Tariff Announcement Day. President Trump's expected to reveal a plan to impose levies on potentially trillions of dollars worth of goods imported into the United States. We'll dive into how these policies could affect your grocery bill. And the reality of the labor market, we speak to an economist about what the data says about the job market and what the average job seeker should keep in mind as recession headlines dominate the news. Plus, all week on Wealth, we're talking about student loans ahead of the 25-26 school year. Today, we're digging into the specific expenses that student loans cover and how current college students can build their credit. You don't want to miss it. First, let's take a look at some of the market action here 90 minutes into the trading day. And we've seen stocks turn positive here, even as investors are bracing themselves for President Trump's tariffs rolling out this afternoon. The NASDAQ right now bouncing between gains and losses, but the S&P very slightly higher, the Dow up by about 60 points. Joining me now is Tyler Ellegard, Gradient Investments Portfolio Manager. And Tyler, you, like everyone, you've been trying to reassess the risk here, and you've also been rebalancing your allocations amid this uncertainty. So how are you thinking about the uncertainty, and what kind of process are you going through to rebalance?
Yeah, look, I mean, the market the last couple of years has been fantastic. And so if you've been a 60-40 investor, a balanced investor for the last 2 years and done nothing, your portfolio is now a 70-30 portfolio. So you're taking on a lot more risk than what you may be expecting. And so that's why we've been advocating for our clients to rebalance their portfolios and reassess their risk overall, because there just is so much uncertainty. And even when we get the announcement today, who knows what's going to happen after that? Right? There's a changing landscape. The tariff market, if you want to call it, is very, very fluid right now. And so these tariffs could be gone, or certain items could be excluded from tariffs in a couple of days. Who knows? So there's just a lot of uncertainty. And so that's why we're trying to reassess our risk and rebalance our portfolios to pull back on the aggressiveness.
And are you going still back towards that traditional 60-40 model here? Is that an appropriate sort of balance for you? Are you retweaking things within stocks, for example, to go more defensive? How is that playing out?
Yeah, it really depends on the investor, right? So a good example of what we've been doing is in a full equity portfolio, full growth portfolio, we've actually held what we call a hedged equity position. So that's been including buffered ETFs, it's include covered call strategies. It allows us to have some type of protection or take some of the profits that we've had over the last couple of years and try to mitigate some of these losses, because we are expecting volatility to return this year. Our theme has been bring an umbrella. So we've been expecting some type of pullback or correction in the market. So that's what we've been doing in our portfolios, is adding those types of things to try to protect us on the downside if there is that correction, which we are now seeing.
And what are you telling your clients in terms of your outlook for whether things are going to calm down in the short term?
Short term, I think we're going to continue to see the volatility, quite honestly. But our view is that we'll end the year positive, right? So we have to weather these storms. These types of corrections are normal. There's different catalysts to all of these corrections, but going all the way back to 1980, the average correction in the market each year is almost 14%. And so we just saw the dip a couple of weeks ago below 10. We're now sitting about down 8%, down 9. So this is normal course of action for the market. So there's no reason for our clients to panic or any client to panic at this point. We have to assess what these tariffs are going to do to the companies. And so for right now, we need to make sure that we're remaining invested rather than trying to time the market at this point.
And let's talk about some of the things that you're getting invested in. That seeing the dip, you're maybe stepping in here. One of the examples is Walmart, which I think is really interesting. Obviously, the company gave an outlook that the market didn't like, talked about caution around the consumer. At the same time, we've seen reports that Walmart is trying to sort of exert some pressure on its Chinese-based suppliers in the face of tariffs. So why do you see that as an opportunity right now?
Yeah, certainly Walmart will be facing tariffs with a lot of the products that they're importing. But we have a changing consumer landscape right now. Consumers are still grappling with price increases from 2021 and 2022, and now we're starting to talk about these tariffs. And so that changing landscape, consumers are going to be going to the lower cost items. They're going to be focusing more on the grocery area because those are the necessities that they need. And that's really where Walmart plays. And you can compare them to Target, right? Where there's a lot more discretionary spend at Target versus necessities at a Walmart. So that's why we like Walmart. It's pulled back that 15% or so. And so I think this is a good buying opportunity for a longer term investor.
And then there's one other pick I want to pick your brain on, so to speak. It's tax season, right? So Intuit is one of your picks. And that's a stock that is sort of, had its ups and downs, so to speak. Why now is that one that you're looking at?
Yeah, look, there's two things in life that I would say are certain: death and taxes, right? And so when we start thinking about how Intuit can incorporate AI into their platform and then start charging different tiered areas for different use cases within AI and utilizing those to complete your taxes, I think going forward, yes, Intuit is a little bit more expensive, but the growth that they can provide and the necessity of taxes, it's a tailwind going forward for Intuit at this point. And so on this pullback, I know they have had their ups and downs, certainly, but I think this is a good opportunity at this point to step in here.
Thanks, Tyler. Appreciate it.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Joining me now, Alexander Canal, to talk through these. And today we're looking at Meta, TKO Group, and Nintendo. First up, we've got TKO and Meta. They've announced a new partnership. Meta's going to bet that UFC's fan technology partner and will be its brand technology partner and will have its branding in UFC's Octagon ring for pay-per-view and fight night events. TKO's head of global partnerships saying Meta will be the official marketing partner, AI glasses partner, wearables partner, and official social media partner. I'm not sure what all of those mean, Allie, in terms of how it's going to play out. We know that this is separate from the broadcast rights. This is just a bunch of other stuff.
I mean, the AI glasses partnership sort of stuck out to me because I remember when Meta first came out with these glasses and they were really leaning in to AR, VR, the metaverse. Right. This was the pitch, right? That you could put on these glasses and you could be front row at a lot of these games. You could be in the action. But then the metaverse, it sort of sputtered out a bit. People seem to have gotten less excited about some of those offerings. The shift sort of focused on, other use cases for AI, being a hyperscaler, things like that. So I wonder, to your point, what this is going to mean. I mean, social media-wise, it seems like they're going to really lean heavily into Threads, into Instagram, and it does kind of remind me of these big tech players partnering with leagues like this. You have Netflix with WWE Raw. I was just at the MSG game for WWE a few weeks ago, and Netflix was all over that place. You had the actors of shows, you had comedians that had specials exclusively on Netflix showing up in the audience, but also as part of the program, as part of the show.
Interesting.
So it just sort of reminded me of that, with Meta getting involved in sort of these big tech players really embracing more niche, I would say, sports. And for Meta too, I mean, we know Mark Zuckerberg, he loves his combat sports.
He does.
Big Dana White fan. So this sort of brings them.
And the reporting seemed to say that those two, Dana White and Mark Zuckerberg, didn't negotiate this themselves, but the fact that they are now
Dana White's on the Meta board.
Right.
Yes.
I mean, for the glasses, you could envision a scenario where you'd be actually at a fight, put the glasses on and see some kind of commentating where they could indicate things, or
or maybe you have like threads or some sort of
scrolling
at the same time. Maybe should we get employed by Meta and UFC to help them out with this?
Give us a call. All right, next, let's talk about Nintendo unveiling the long-awaited details for its Switch 2. The new gaming consoles will hit shelves on June 5th. They'll cost $449, let's just call it $450 here. The new Switch 2 will be larger and faster than the original version. And people were really waiting for this, right? Because some of the other past rollouts from Nintendo have been a little bumpy.
Right.
People are really pumped for this one.
Yeah, whether or not they could build on the success. And I'm not a gamer. We did ask our resident gamers, Dan Halley, he's our tech editor, Dan Nelson, he's one of our producers. They are huge fans, and they seemed very, very excited about this. And basically, it's better, faster, stronger. That's sort of the read-through that I got. I thought it was interesting that the site says the system has a, quote, custom processor made by NVIDIA. And that's how NVIDIA started. Before they were offering these chips to the hyperscalers, they were powering video games. So there wasn't many details beyond that, but that's something that stood out to me. Nintendo, it's also going to have a new game share feature where you can play games with local players. So sort of going back to the heyday. But again, I'm not a gamer, but those that are, they seem very, very excited.
Well, and they also talked about the integration of the games with the hardware, that there is a new version of Mario Kart coming, for example. And that having the new Switch is going to somehow enhance that game. So
enhance the game, and I think run better, right, on the hardware as well. And you know,
load faster, all that stuff.
Exactly. And back in college, I had a lot of friends that loved playing Mario Kart. So maybe it'll be a little resurgence. I was never good at it though. So maybe if I was good, I would have gotten into it.
I did see the Mario Brothers movie.
Okay.
That's
something.
Does that give me any kind of
You're tangentially associated.
Sure,
you know?
sure. Thanks, Sally. Appreciate it. Coming up, forget the traditional 60-40 portfolio strategy. That's the message from BlackRock CEO Larry Fink, why he says investors should diversify into private market assets. That's next on Wealth. Grocers and food retailers are preparing for a fresh round of new tariffs. In 2024, the U.S. imported more than $200 billion worth of agricultural products. According to the USDA, a large portion of those imports were fresh fruits or vegetables that, given climate differences, they can't be easily produced in the U.S. That leaves sellers with little alternatives to higher tariffed goods. Joining me now is Abhi Ramesh, CEO of Misfits Market. It's an online grocery store that offers sustainably sourced groceries with a focus on rescuing food that might otherwise go to waste. Abhi, thanks for being here. So obviously, you guys are watching this very closely. How are you guys preparing for this, and what part of your assortment could be affected by these tariffs?
Yes, so we've been doing preparation work for the tariffs on produce specifically for a couple of months now. Obviously, it's been whether or not they're going to go in effect has been changing every other week. So it's been a little bit of whiplash. But a lot of it has been doing some planning with our vendors, with our freight providers, and coming up with kind of a pricing strategy internally as well. Today, at Misfits, we offer north of 1,000 different items in our catalog. It's probably around 40 of them that will be impacted directly by tariffs for Canada and Mexico. Now, these are also 40 of the highest velocity and most popular items, probably. So when you think about produce, a lot of the avocados, probably close to 90% of the limes that we sell in the United States, bell peppers, tomatoes, those are all items that, at least for this time of the year, are coming largely from Mexico. So those will be items that will be mostly impacted. So we've been doing a lot of prep work on pricing strategy and working with our vendors as well.
And how about alternative supply chains? I was reading earlier this week in the Wall Street Journal about Chipotle trying to find other supply chains for avocados, for example. But the problem is that we in the U.S. like Hass avocados, and there aren't that many countries that grow them at this point. So have you been trying to diversify at all? And if so, have you run into some of those kinds of hurdles?
It's a great question. So we generally source in the U.S. When we can for most of our commodities. And so our team's done an excellent job of diversifying the supply chain and focusing on local growers over the past couple of years. The reality of the situation, though, which which we've been spending a lot more time on, is a lot of the items that grocers and restaurants are buying from Mexico today they can kind of only be grown in Mexico, given the growing environment. So let's use limes, for example. So people don't think about this, but close to 90% of the limes that are sold today in the United States are grown in Mexico. And it's not because people don't want to buy limes that are grown in the United States. It's that the very specific tropical or subtropical climate that is required to grow limes doesn't exist in the US outside of a couple small parts in California and Florida. And so the vast majority of limes have to be imported from Mexico. So we have been looking for alternative supply. We try to obviously source locally in the US when we can, but I think a lot of other grocers and retailers are going to be the same boat, where some of these items you simply cannot source from the U.S. in certain times of the year.
Yeah, it's not a reshoring proposition here. So you talked earlier about your pricing strategy and having to sort of attack that. So are you planning to pass the full additional cost of those tariffs onto your customers?
So right now, our plan is not to pass on the full cost. Our plan is to probably pass on a portion of the cost. Now, Misfits is in somewhat of a unique situation because of the way we purchase items with our kind of rescue mission, our ability to buy opportunistically. We generally have a little bit more flexibility on pricing strategy than a lot of other grocery retailers. I think we're going to probably be able to shield our customers somewhat from the full burden of the tariff impact. That being said, I think consumers on our platform, plus probably any other grocery store, can more likely than not expect higher prices than before. And certainly on some of these commodities like avocados and limes and bell peppers and field-grown tomatoes, where 80-90% of the supply right now in the US is coming from Mexico and there's not a viable alternative, I think consumers will see higher prices more likely than not over the next couple of weeks.
And Avi, just quickly, you guys have a direct line to your consumers because they are buying it directly from you online. Are you going to tell them? Are you going to send a note and say, sorry, we're raising some of our prices because of what's going on with the tariffs?
We plan on being really transparent about it. Right? I think most consumers are really savvy, they're educated, and they also are interested in understanding what is going on in the food supply chain, and especially recently. So our plan is to communicate this transparently. Our plan is to probably send an email out, push notification out via the mobile app and saying, here's what we're doing, here's why. We've also generally kind of focused on storytelling to our customers, explaining how products got from the farm to their doorstep. So this is just going to be another piece of that story.
Avi, thank you so much. Really interesting stuff, and good luck navigating all of it.
Thank you.
BlackRock CEO Larry Fink is proposing a tweak to the traditional 60-40 portfolio strategy. Yahoo Finance's Carrie Hannon is here now with more on Fink's proposed portfolio model. Now, Carrie, we should say he's not the first guy. I've seen sort of an increasing drumbeat of this kind of proposal over the past couple of years, but it keeps getting sort of more and more high profile.
Yeah, Julie, you're absolutely right. I mean, this idea has been floated around for a while. But what's interesting is his letter that came out this week is very powerful in getting a message of what the big trends are out there. And what he's proposing is the idea that the investment portfolio goes from 60-40, which has sort of become the benchmark for 60% equities, 40% in bonds, to kind of teeter-totter, even out markets. When things are flying high, you've got your equities. When things aren't so great, you've got the bonds to kind of moderate things. So this creates a really moderate portfolio moving forward. What Larry Fink is saying, a 50 equity, 30 bond, 20% of the portfolio goes into alternative investments. And he's talking about infrastructure things, real estate, that sort of thing, private equity. And this idea is to sort of build out even, he said, we absolutely need more diversification because even though the other model has been successful, and it's now being tested by inflation, by volatility, by these rapidly changing policies, and people just don't know the uncertainty. Anything's moving forward. We need more oomph on the diversification. Now, just quickly, I'll say there are drawbacks why this has not happened to date is these can be quite expensive for an individual to get into, minimums of maybe $50,000 to get into private equity. You have to have salary limits of minimums of say $200,000 a year and more, or $5 million in assets. They're not very liquid. They can have high fees with them. And so it's not as palatable for an individual investor to get into these kinds of things. So I think that we're going to see some movement if he's really pushing to this diversification rate. But we'll see what happens for whether individuals can find a way into this in order to build out moving forward.
Yeah, I suspect that this industry will get creative in the next couple of years and come out with some alternative asset products, perhaps, that might be a little bit more accessible. And that brings me to my next question, which is, would this work in a 401k kind of format for retirement savers?
Yeah, Julie, I love that question. And he does address that. He says, Fink is concerned that retirees simply aren't going to have enough with their Social Security checks in order to meet their cost of living moving forward in the future. And so his idea is, okay, let's do this. This is perfectly legal to have these private asset in a retirement plan. There's nothing holding people back, except he says that 401k providers just aren't familiar with the people who actually make these selections right now, don't quite understand how these work. And his suggestion is, okay, most people love target date funds, right? These are funds where you're setting the date you might retire. Maybe it's 2045, 2055. These have long-term ranges before someone's going to dip into them. He says, put that 20% in a target date fund. And that way people understand that it's for the long term. They're not trying to live on that money tomorrow. And carve out 20% in a target date fund that will go to these alternative investments, this proposed portfolio model that he is advocating.
Carrie, thanks so much. Good to see you.
Thanks, Julie.
Coming up, we'll check up on the health of the labor market with an economist. We'll get to the reality of how worried job seekers should be about recession fears. That's next on Wealth. Let's get a check on markets here. Despite market participants' trepidation about the president's tariff announcement this afternoon at 4 p.m., we are seeing markets turn higher here. The Dow started the day in the red. Right now, it's up more than 150 points, about 0.4%. The S&P 500 ditto, also up about 0.4%, and the Nasdaq Composite up about 0.5%. Now, remember, with that announcement at 4 p.m., it means the market will be closed once we get the details of the tariff plan. So we'll be watching the after-hours action and, of course, tomorrow's action very closely. The U.S. added more private sector jobs than expected in March, according to the latest ADP data. This coming after the BLS reported fewer job openings in February. So what does this data really tell us about the health of the U.S. labor market? Joining me now is Kathy Bostjancic. She is the chief economist and senior vice president at Nationwide. Kathy, thanks for being here. So we've got some hints here that we can use perhaps heading to Friday's jobs report. But what are the data that we've gotten thus far? What is it telling you?
Yeah, hi, happy to be with you. It's telling us that the labor market, as of now, is still in very good shape and healthy. Along with the ADP numbers, we've seen jobless claims every week remain incredibly low. And we think that, on Friday, we'll get a solid payroll advance, probably somewhere around 130,000. And we think the unemployment rate stays quite low at around 4.1%. So, as of now, labor market remains strong. And that's really good news because it does give the consumers income wherewithal to weather some of the higher prices that will be coming through, with the tariffs.
The JOLTS survey, right? The job openings number ticked down a little bit. We've seen layoffs tick up a little bit. Any warning signs there yet?
So, we're watching it very closely. The JOLTS data, as you mentioned, did pick up some of the increase in layoffs, particularly with the federal workers. But it's still rather contained. I think some of that effect's probably going to be felt more as we get through towards the latter part of the year. Some of these workers are on deferrals, and most are increasingly reading that some are being offered jobs in the state and local government sector. So that's very encouraging. But obviously, as the economic activity, as we think, slows, and it's become bumpier, right? The first quarter growth is essentially stalled. And we think you do have those headwinds from the tariffs. And let's not forget that we were already, most of us, and we certainly were looking for some moderation in economic growth because the last couple of 2 years or way too strong to be maintained. But fundamentally, underneath of it, labor market, consumer still looks healthy to us.
And Kathy, we tend to talk about jobs as a lagging indicator, right? That they slow more slowly or with a lag to what happens with economic growth. How should people who are watching the job market think about that? What's the typical lag and how does it usually sort of play out?
Yeah, that's a great point. I would say the unemployment rate is a lagging indicator, and that could be several months to maybe 6 months of a lagging indicator. The establishment, the payroll data that we get as well, I would say call that more coincident, and that's a reflection. What's the labor market now? And it really becomes coincident because we'll get that data on Friday and then we'll look at the wage growth and we'll make an estimate of what we think personal income growth will be for March or any given month. And then we can project, okay, that's going to support or maybe hurt consumer spending in the current month. So it becomes a very coincident indicator in that sense. But yes, the unemployment rate tends to be a lagging. That's because you have changes in labor supply. So it's not just the number of people employed, but it's also the number of people coming into the labor force, looking for a job.
And all of this brings us to the payrolls report, which you mentioned, which is on Friday. Any parts of it that you're going to be paying a special attention to?
So we'll try to, digest all of it, to be honest, all really important, but particularly we'll focus in on what we think is like the core portion of private payroll growth. And that particularly, will get you zeroed in on the services. And we may even look at services ex healthcare and education. Not that healthcare and education don't matter, they certainly do. But we have seen those consistently grow. They're kind of secularly growing. So maybe looking at the private sector ex those will be important. Of course, looking at the federal government, seeing how employment is playing out there. But keep in mind that the other half of employment in the government sector comes from state and local. So there can be that offset and balance there. And then lastly, I would say wage growth. That really matters a lot. It determines income for consumers, but also gives the Fed some sense maybe of how inflation pressures are playing out, whether the labor market's too tight or easy. I think at this point, though, the Fed's probably more worried about prospective slowing than necessarily wage pressures.
Right. It does feel that way. Kathy, thank you so much. Appreciate it.
My pleasure. Thank you.
Coming up, budgeting tips for college students, including a look at what expenses you can and cannot spend your student loan money on. That's next on Wealth. Elon Musk is reportedly preparing to step back from his current role in the Trump administration. That's according to Politico. And we should mention, after the report, Tesla shares, that's coincided with them turning positive along with broader markets. They reversed earlier losses that were fueled by their miss in first quarter sales. We saw first quarter Tesla deliveries down 13%. The president, according to Politico, is pleased with Musk's Doge initiative, but the two have decided that Musk was ready to step back so he could focus more on his business. Per Politico, Musk will remain involved in the administration in a supporting role. Now, Musk has previously acknowledged the toll his time in the Trump administration has taken on Tesla. He's called his advisory role a, quote, very expensive job. As we've been talking about, it's not clear, even if he returns to Tesla, if it will undo some of the brand damage that seems to have been done to the company. That will remain to be seen here. It sounds like, according to Politico, the timing of Musk going back to Tesla in a more full-time capacity would happen in the coming weeks. So we will see if and when that does indeed happen. All week long on Wealth, we're talking about student loans, from signing up to making your first repayment. And according to the College Board, current college students are spending an average of just under $3,000 per month and about $26,000 for a 9-month school year. Joining us now is Daniel Mercado, University of San Diego finance professor, credible money coach, and personal finance expert. So, Dan, thank you so much for being with us, first of all. And what are college students spending all this money on? I mean, we know they have tuition, we know they have board, but break it down for us.
Yeah, hi, Julie. Thanks for having me back. It's a lot different now than it was when we were in school, I think, So first of all, obviously everything's just so much more expensive because of inflation and whatnot. And what we're seeing is that college students spend about half of their monthly budget on housing, whether that be on-campus housing or off-campus housing. So that's a big chunk right there. About 30% of it goes to transportation, food costs. You got to feed those kids in college, right? And listen, they want avocado toast, not ramen noodles. So that's gotten more expensive as well. Transportation, cell phone travel, that kind of makes up the other 20%. But all in all, no matter how you look at it, Julie, it's pretty expensive.
So the loans and grants and all of the monies in financial aid that these kids are getting, are there requirements, are there limits on what they can actually spend those funds on?
Yeah, good question. We have to draw the distinction. There's two types of loans, as you know, Julie. There's private and federal. Now, most students go with the federal student loans. Everyone qualifies for a federal student loan. Whether you're Elon Musk's child or one of my middle-class kids, you qualify for a federal student loan. You're capped annually on how much you can receive from the federal government. And you have pretty broad definition of what you can use it for. Education-related expenses, tuition, room, board, transportation, a computer, for example. An energy drink can qualify. Keg party, probably not. So you have to use it for technically expenses related to your college experience.
That's kind of amazing. Energy drink, right? If you're staying up all night studying, I guess, and you can justify the expense that way. And what are your tips for incoming students who might be worried about their finances?
And that's the real key. You and I have to focus on what we can control. We can't necessarily control inflation, but one of my tips for all of my students, and my own kids included, limit your borrowing to your expected first year salary. You're going to become a chemical engineer, go ahead and borrow 90 grand. Studying basket weaving, change your major. Ignore the sticker price. As you know, there's the sticker price at the schools, but the big schools with expensive sticker prices are also the most generous schools when it comes to scholarships and financial aid. So forget the sticker price, apply, and let's see what the school comes up with. Work part-time, that's the key. And it also, by the way, adds to your resume, your skill set. The best way to pay for college, have somebody else pay it for you. You can work part-time at Walmart, part-time at Starbucks, and they'll pay for college, right? So check out those employer paid benefits. And finally, Julie, something I call the 2+2 strategy. 2 years community college, especially for those students, those young adults that are not really quite sure about college yet, right? So it's a low cost, low impact way to figure out if this is really for you. 2 years there, 2 years to a regular 4-year college, you'll come out with a 4-year college degree, and you'll save a boatload of money.
Yeah, and Dan, it feels like community college is getting a lot more sort of acceptable as college has gotten a lot more expensive. So that makes a lot of sense for people. Thank you so much. Appreciate it.
Thanks, Julie. Take care.
You too. According to Wallet Hub data, over 85% of college students have at least one credit card, and they carry an average balance of just over $2,000. For anyone who's new to using credit or isn't sure how to build it well, we've got Yahoo Finance's Kendall Little here with some tips for students. So where can students get started? I mean, people who have never had a credit card, they don't know where to start. What do they do?
Yeah, so opening a first credit card as a student is actually a great way to start building your credit. Even if you have no credit history at all, there are still some cards that you can qualify for. One of those is going to be a student credit card. Like the name implies, these cards are typically geared towards students. They have no annual fees, and sometimes you can even earn rewards on your spending. But they do still carry those high interest rates that we see from other cards. The second type of card that you might want to consider as a student is a secured credit card. These are a little different because they require a security deposit to open them, and that's typically going to act as your credit limit. So whatever you put down is going to be how much you can spend on the card. And then over time, as you sort of use it responsibly, you might qualify with your issuer to upgrade to an unsecured card and get that deposit back.
Gotcha. And so once you have the card, what are some of the do's and don'ts of using that credit card?
Yeah, so probably the most important thing to remember is to only spend on your card what you can afford to pay off. You know, these credit cards have super high interest rates. We see today interest rates that can go as high as maybe 30%. So you want to make sure that you're not taking on those interest charges and paying off your balances. Use your card like a debit card. Pay your essentials or whatever else is in your budget as a student, and make sure that you can pay it off at the end of the month. As far as building credit, one of the best things that you can do is also pay those bills on time. So you want to avoid a late payment or a missed payment, because those are the things that can get reported to the credit bureaus, show up on your credit report, and then ultimately negatively affect your credit score. Kind of along those same lines is credit utilization. That's going to be making sure that you aren't spending too close to your credit limits. So, you know, if you have a $500 credit limit, you want to keep that under about 30%, so maybe $150 of your overall credit. And that's going to be another way to help build your score.
That's really, I actually didn't even know that latter tip. Thank you so much, Kendall. Of course. Appreciate it. Well, coming up, find out the steps you can take today to prepare your finances for a potential slowdown or recession down the line. A brief programming note on today's episode of Trader Talk. Kenny Polcari discusses trading amid market uncertainty.
Markets like this, I think, are good times to take inventory of what you're doing. Okay, right. So when you see these pullbacks and you take a look, you talk about the lunatic investor, and that's something where I put out, kind of model portfolios, and we've got the market momentum stocks that have been crushing it, that have gotten killed this year. But we got our
momentum on the way up, momentum on the way down.
Exactly it. Right. But then we've got our dividend growth stocks that are up 3%,
That's
right? And so then you get to take a look at, okay, maybe I'm not as a momentum as investor. Maybe I need to shift more into these. And that's, kind of what I'm telling people is, to your point, if you feel like your stomach's upset, you can't sleep at night, it's probably time to readjust some of those things.
It's time to at least look at what you own.
You can watch full episodes of Trader Talk every Wednesday at noon Eastern on Yahoo Finance or wherever you get your podcasts. Some of the biggest firms on Wall Street are raising their expectations of a recession in the next 12 months. While it's far from certain that it's in the cards, we are bringing you some steps you can take today to prepare just in case. Joining me is Jean Chatzky, CEO of HerMoney.com and host of the podcast Her Money with Jean Chatzky. And Jean, we should say here, a lot of these folks are not predicting a recession. They're just raising the chances that it could happen. Most of them are predicting a slowdown from the growth where we are right now. What should people be looking out for? What signs that could signal a slowdown or even a recession is coming?
We'll keep an eye on unemployment. Unemployment is likely to start ticking up if there is a recession. We'll look at consumer spending. Consumers often lose confidence. We're starting to see declining consumer confidence already. If we see a slowdown in consumer spending, that can be another sign that we are headed into recession. But the tricky part about a recession is that we could be in one already and not know it, simply because the data lags. And so for individual investors, the thing to keep an eye on is your own finances. You want to focus on controlling the things that you can control, making sure that your job is shored up as much as possible. And if you feel that it's tenuous, making sure that you are taking steps right now in terms of brushing up your LinkedIn, brushing up your resume. You want to make sure that you're keeping a little bit of extra powder dry in terms of savings in case you need it in an emergency. You're not going to be able to control the roller coaster markets, but you are going to be able to keep a lid on your own wallet, at least to some degree.
And speaking of controlling things you can control, Jean, it's a good reminder what you were saying about your LinkedIn. Also, that we're not at the height, the job market is not necessarily weak right now, but it's not at the height it was a couple of years ago. So if someone's preparing to leave a job voluntarily, they should probably have another one lined up.
Yeah, absolutely. I mean, we stop and think, oh my gosh, a recession, I'm never going to be able to get a job. No, hiring happens continually. It just happens a little more slowly in a recession, which means it may take you a little bit longer to get that next job. And so, Julie, exactly what you're saying is what I would say. Don't quit the job until you've got the next one lined up. Now is not the time to do that.
How else can people sort of prepare their budgets if there is going to be a slowdown? How should they be assessing things?
It's always important to keep an eye on what's coming in, what's going out, and where it's going. And that basically means tracking your spending. You've got a lot of control, more than you would think, about where your money is going. The problem is that many people simply don't pay attention. And that means that they're not saving as much as they possibly could. So track your spending for enough, make some changes, cancel the subscriptions that you're not using, try to keep a lid on your takeout budget. Food is always the surprise when people look at their budgets. And then make sure that you're putting your money to work for you in a savings account that actually gives you something for the fact that it's holding on to your money. You put some money in a plain vanilla savings account at a bank, you're going to get an average interest rate of 0.4%. Put it into a high yield savings account, and you're going to get 7 times that. That is truly significant. Barclays is rolling out a program for AARP members, for example, where AARP members with no minimums can know that they're going to get the highest rate that Barclays is offering on a high yield savings account with FDIC protection. They're doing the same for a number of CDs. So it's really just a matter of smart shopping. And if you're looking for information on that particular program, you can find it at aarpdigitalbanking.com.
Okay, good tip there. And then finally, what are some mistakes that people should try to avoid with their money if things are going to be slowing down?
You want to keep a lid on that credit card debt. We are seeing credit card debt and other consumer debt rising pretty quickly. And with interest rates on credit cards still in the high 20% range, that's very, very expensive debt to be carrying right now. So it really all comes back to those basics. The other thing that you want to make sure that you're not doing is behaving emotionally. That's true when it comes to impulse spending, but it's also true when it comes to how you're managing your portfolio in the market. Don't try to time things. Just keep contributing to your 401ks and your other accounts as you get paid every single time.
Jean, thanks so much. Good to see you.
Nice to see you.
Let's do a final check of the markets here. Now, as we talked about, we have seen things tick higher here for the major averages. The NASDAQ is leading. It's up 0.33%, and it's being led higher by Tesla. As we told you, there was reporting in Politico that President Trump has hinted that Elon Musk might step away from Doge in the coming weeks. This is after, by the way, a defeat in the Wisconsin judicial race that Musk had heavily funded. That's it for Wealth. I'm Julie Hyman. Thanks for watching. And stay tuned for Market Domination coming up at 3 p.m. Eastern. We'll also have special coverage of President Trump's tariff announcement at 4 p.m. Eastern.